Morning. Crazy weekend already. So, about ready to get into this. Give the guys a couple minutes to hop in. If you're out there, welcome. What is going on? Appreciate everybody hopping in. If you're on YouTube, send it out to Twitter, Instagram, wherever you are. Got a couple big trades this week. Got a ton of stuff to go over, and actually have a little bit of the macro to go over with you guys, just because I feel like sometimes it's a little over the top. The title today is what's going on, man. The title today is Investor's Nightmare and a Trader's Dream. So that's what we're going to go over. It's a little bit of both out there in the marketplace. So you're hearing all this crazy stuff about the banks and things like that. Not really sure what to do, what to think of what. But here we go. We're going to go ahead and hop into this real quick. All right. So weekly trade plan. If you're new to this, welcome, by the way. Every Monday we go through and we basically just kind of plan out the week. We're going to go over a couple of the headlines that hit this last week and weekend, what to look forward to moving into the rest of the week, and look at a couple trades that may have already been going down. And most importantly, for a lot of people, we'll go ahead and find a couple plays that I'm looking at for the coming week or weeks moving forward. So that said, that is where we are. Recap. All right. So I already did the disclaimer. I'm going to skip that. So Silicon Valley Bank, blah, blah, blah. More and more of this. So over the weekend, there was an announcement also this morning. FDIC also relaunching sale of the SVB assets, just trying to get basically a higher bid. So if you guys don't know, back in the financial crisis, there's this Bear Stearns thing. They actually, I think, got delisted at like $2 a share, but eventually sold for $10 a share. For us, regular retail people, really not going to matter a whole lot. That's just what it is. There's a lot of other noise, though, that is kind of important. And that's about uninsured or unlimited insurance on deposits, things like that. That's actually starting to expand the Fed balance sheet quite a bit. And when you start hearing about that kind of stuff, especially on social media, things like that, or just regular media, you'll start hearing a term called QE, which is what we heard way back in the day, post-COVID. That's quantitative easing, and that's essentially the increase of the Fed's balance sheet. And we've been working on, the Fed has been working on, government and Fed working on fixing this balance sheet situation. We keep talking about balance sheet reductions and things like that. Well, over the last 2 or 3 days, like all of that got thrown away, literally in about 72 hours. So that said, there is a little push and pull in the market, and you guys are seeing bond yields actually coming down quite a bit. If you're looking at bonds themselves, the papers, again, that is inverse to the yield. Yeah, 30% QT reversal in a week. Yeah, that's basically what happened. So all the progress that the Fed has had, like they've had on the balance sheet, gone in like a week, less than a week, actually. It was pretty much, overnight, a couple days, basically. Huge moves in gold, right? So everybody's seen the gold trade. I think we were probably one of the first ones on it, maybe, admittedly a little bit early, but still very much intrigued with gold. And the reason I wanted to go through a little bit of the macro for you is I personally like some of these like macro high level theme trades, and gold just happens to be one of the very best that I could think of at the moment. That said, I have another one coming that I'll just kind of skim through. I'm not sure if it's completely ready yet. But again, we're going to go through essentially what's going on in the economy, scenarios that could play out, and how you want to position your portfolio moving forward. So I think pretty important, maybe not so, intra-week trade centric, but here's the deal. This Wednesday, we get the FOMC notes or FOMC rate decision, which quite frankly is going to be completely wild, right? So this week, I would just say even gold, I know we have a lot of gold bugs and a lot of gold miner fans out there, but even in that scenario, here's the thing. If the Fed raises rates, I honestly think, okay, so the gold trade could stall. Don't get me wrong, I'm a big gold fan. There are a lot of gold haters out there. So, like, as a gold bug, you kind of need to be aware. There are a lot of people chomping at the bit, trying to, getting ready to short gold. So we do need to be cautious of that. I think it's a possibility. I wouldn't say that it's going to completely fall off a cliff. I think it's well supported around 170 GLD. That is 170, 168 ish. But the other note is, if we don't get a rate hike on Wednesday, and with the environment that's going on, there is a pretty good case to be made for the Fed to actually not raise rates. So if that happens, okay, the gold bugs are going to win. That's just my opinion. I think the gold trade moves forward with 2x momentum in the event of no rate increase. I'm not even going into a rate decrease or anything like that. But in terms of the liquidity situation that's going on, what does that do to the risk of borrowers and things like that? Credit will tighten, right? Credit requirements will tighten. Spending will kind of get shut off, right? Liquidity concerns in general. I mean, people just, in economics, there's a push-pull that we have going on, but the strength of the economy, essentially inflationary, deflationary, stagflationary, we need this velocity of money to happen, right? So the more money that's moving back and forth, the higher inflation becomes. The less money that's moving back and forth, the lower deflation starts to pop up and prices start to come down. The thing is, even if there's nothing real, what's true is that the perception of these things in the general economy are actually going to move markets and are actually going to create the scenarios that we might be looking forward to. So in this case, because of the liquidity concerns, because of credit potential crisis looming, I'm just going to say that, that may do a lot of the jobs of Fed's job for them without having to do anything, right? So just because people are a little bit more concerned about spending money or, am I going to have this kind of income in 6 to 9 months, they might stop spending a lot of money. What are you saying here? Money moves from smaller banks to bigger banks. Yes, much tighter lending standards for sure. Pulling forward reception. I'm not sure what you mean by pulling forward. Maybe pulling forward reception. This is, again, that's the perception thing, right? So if people don't think that they're going to have this type of, funds available moving forward, spending just stops, right? So what do we need to look at? We need to look at retail sales. We need to look at home sales, new home sales, and a lot of that kind of stuff moving forward. And the biggest number is going to be on inflation and actually inflation expectations. So anyways, here we go. More FRC, First Republic Bank, shares falling on a private placement report. And we still have this Ukraine situation. So she is over in Russia right now. I don't really know the outcome of that, but I know that that's also kind of looming. So just going to do a quick recap on the actual numbers that came in. I changed some of these to red that were below consensus. So remember, if you're looking at this, right, what matters is that what comes in above or below consensus. The previous number doesn't really matter as much as the difference between the actual and the consensus number, these two. So consumer inflation expectations. So I put this here because remember, it's about the expectations of the consumer. It's about the perception, right? So right now, consumer inflation expectations actually came in below prior and significantly below consensus. So right now, the consumer isn't really too worried. That's what this number is telling us, at least for February. The actual core inflation number came in pretty flat year over year, actually exactly flat, 5.5 at consensus and 6 at consensus for the headline number. Core inflation, remember, is different than headline inflation. And we got PPI also. So we have a core PPI and we have headline PPI. This one actually came in slightly lower, right, than consensus. So that's kind of good. depending, right? So there's more to look at, right? Unfortunately, retail sales came in lower, right? And the biggest one, Philly Fed manufacturing. So the manufacturing index, we're going to get into why these components are important. This is more about GDP and our production, right? So negative 23.2, consensus of 15.6. We are not really getting any better. These are really, really low, really, really no numbers, right? Actual for March consumer sentiment coming in at 63.4, again, marking new lows. So, well, maybe in February, it didn't look like consumer expectations were so bad. As we start moving forward and we get more of these numbers, it's like, well, inflation is sticky, right? It's not coming down. Thankfully, it's not going up, right? Producer price indexes, yes, they're going to come down, but guess what? They're probably not going to be passing those savings on to the consumer. So my gut, consumer inflation gonna be a little sticky. GDP and Philly Fed manufacturing index is going to be more related to GDP. Growth going down, right? Retail sales coming down. So spending going down, growth going down, sentiment, yes, down. I don't want to paint a bad picture. There are some really bright spots in this economy, and some really good places to have some really good trades. But it's more important to really be aware of, in my opinion, where not to be, right? So we know gold is number one, first and foremost. That's the one place that's not going to have any major exposure. So in our server, I kind of mentioned this a little bit. So there's three essentially phases in my mind that I'm trying to play this out and be like, okay, what's the best way to really, paint this picture, right? So at the bottom of this slide right here, we have stagflation, inflation, deflation. These are essentially the three scenarios that we typically plan for as investors, right? Right now, we're seeing something called a flight to quality. Why? Well, that's again because of liquidity concerns. High free cash flow companies with very little exposure to the need for credit or banks or tied to banks in general. That right there, we're going to see Microsoft, Google, not so much Amazon because they're pretty tied to the consumer. Meta, things like that, Apple, companies like that are essentially like their own little ATMs. They don't need to leverage so much like credit line and debt, right? It's just not something that they need, so they're going to do better. They're really just going to be fine. Are they going to explode? I said last week, I believe, I don't know that they're going to explode to the upside, but I'm pretty sure they're not going to get hit either, right? So semiconductors also, in that scenario, that first phase, these are going to be healthy situations, right? More longer term, I'm thinking healthcare, things like that. Gold, obviously, is going to do well in this scenario also, right? But what happens? So if that's the concern, liquidity concerns, we're still dealing with layoffs, by the way. So unemployment is increasing. Growth is definitely slowing, right? In terms of spending and prices, it's not really going to have a big effect. But again, we know that all these mega cap companies, if high free cash flow is the goal or is like the big thing, well, they're not going to be hiring a bunch of people. We're seeing a bunch of layoffs. You're going to hear a lot about it, driving efficiency, which, by the way, has been Meta's number one thing, driving efficiency, cutting costs, right? Because they're not going to get net top line revenue, right? We call organic growth. How do they, with the same amount of sales, become more profitable companies? Well, they cut costs, right? And then we have the situation of well, we're not spending, the growth is slowing. So you get this thing called debt deflation. And this is the next phase in my mind. Debt deflation is actually a huge deal, right? And that is essentially where, okay, if you're a business or even a person and you have credit, you have debt, right? What's on your books in terms of debt? Actually, the value of those assets are starting to depreciate. But at the same time, you're paying interest on your debt. So your debt is staying the same or even growing, right? So your debt is appreciating, but your assets are depreciation. In that scenario, that's when you get into the REITs situation, things like that. You're seeing a lot of the market kind of front run that. But in that scenario, that promotes saving over spending. So again, it's deflationary because prices will likely come down, but no, slow growth. Spending is pretty neutral, if not slowed. And again, because the velocity of money is coming down, it has a depreciating, let's say, force on prices, right? But that's one component. The third piece, and I think the most important piece that is kind of in the mix, and this is where the debate really gets down to, is like supply constraints, right? I mean, I go to the store, I still try to buy a carton of eggs, and it's still like $8 to $10, right? And I'm like, I'm really still paying $1 per egg right now. Sometimes they're not even in stock. I paid like $5 for a thing of orange juice the other day. I'm like, okay, there are things out there that we still have supply shortages on, specifically oil. And this is probably where I'm going to go for the next trade. Oil is one of those things where, you know what? As much as we'd like to be ESG friendly, whatever, not producing oil, there's just so many things in that space that are constraining the supply, right? And especially with stuff like Russia and those oil embargoes, like those things looming, I think that there could be a match to be lit under oil prices. I don't know that I want to say oil companies, specifically like producers and things, but in my mind, the oil services sector has always been the place that I go to, because they don't actually need the price of oil itself, the commodity, to go up to make money. I think if we're still focused on efficiency, the oil services sector, OIH, Schlumberger, those kind of companies will do amazingly well. And I just started rebuilding that position. I think this is a great entry point for that sector also. I'm just reading some of these comments. You guys are awesome. Yeah, IWM jumping. Yeah, so IWM jump cliff jumper, right? So this is specifically where you don't want to be, right? So IWM is where it's not in this high free cash flow company. It's a mid cap company. It's where it's a mid cap ETF that tracks a lot of companies that are leveraged to credit, right? Have high burn rates and have a big need for those kind of credit lines. And so, and by the way, IWM is like 20 or 30%. It's a very high percentage of those regional bank components, which are directly in the blast zone right now. So if I were to pick a place to short, it would be kind of like those mid cap, high leverage companies. Roku comes to mind. I was looking at the chart today. That will probably be a short, right? Anyways, so that's where I'm going. Highly leveraged, unprofitable. There you go. You said it better. Highly leveraged, unprofitable zombie companies. Yeah, there you go. Right. So here's the debate though, right? So if these are the situations, right? So if supply constraints keep prices high, I think 1970s gas prices, right? It wasn't like it was deflationary, but at the same time, there was a bunch of what we call supply shocks, right? And I think, and there's a economic term called Giffen goods, something like that. But there's a category of goods in commodities that defy laws of supply and demand, and these are the goods and commodities really that I want to kind of focus on. So to me, oil is historically not really in that section, but I'm going to put it there for me because again, this is just something that if there was a supply shock to come with the Ukraine situation and all of that stuff looming, I think that's probably going to be, especially at this price, right where crude is specifically here, that's going to be the one where it's like, okay, where are my good entry points? What's my highest risk to reward? Oil services right here, right now, right? Gold last week or 2 weeks ago, right then, right there, that was the best spot. This week, it's oil to me, right? And so do you think that we're going to go into stagflation or deflation? These are two different scenarios, and this is kind of where the conversation gets somewhat interesting because I don't really have anything that's going to say, look, we have things looming that can drive down prices, right? The Fed doesn't necessarily need to hike anymore just because what's going on in the market and that consumer perception is going to naturally slow some of that spending, right? But at the same time, we have these supply constraints that if those start popping off, they're going to be counteracting any of that price decreases. So in a stagflationary environment, again, we know, look, growth is slowing, right? So we're not in an inflationary environment. We know that unemployment is actually kind of peaked, right? We're still having these mega cap like layoffs, things like that. We know that unemployment is increasing. We're pretty close to peak employment, right? We can even call this neutral, if you will. But what we know is for sure is that there are more jobs available than people willing to take the jobs. That's number one. Right. So then the question is, since we know we're not in an inflationary environment, where are we? Are we going to be going to stagflation or deflation? And honestly, it could be either or. Personally, I'm more in the stagflation camp just because I think these supply shocks can be really, really important, right? I think they can have a huge impact, more than people are really accounting for. So I tried to make this as clean as possible, and just wanted to put together a little chart for you guys about historical asset performance, asset class performances in these different scenarios, right? So what are we coming out of? We're coming out of like this Goldilocks scenario. This is like 2010 to now, right? Or ish, right? So US equities, by far the best place to be. REITs also, right? But US equities in the best, like 2% inflation, that's Goldilocks, 2% inflation, that's where you want to be, right? In US equities. In a reflationary environment, this was actually like last year, this is when you'd see, and yeah, so Motion's saying, Max is saying, yeah, industrials, things like that. This is the big oil trade, right? So commodities, 5%, or commodities in a reflationary environment, up 21%. This is historical asset performance, year-over-year asset performance in each of these scenarios. Stocks still did okay, right? So last year, stocks, well, we had a little bit of different scenario. This is, by the way, this is a scenario that hasn't really been exactly replicated before. So I think we have a little bit of different things going on. But what's for sure is we're not in a reflation kind of scenario or disinflation scenario anymore. So I want to have some diversity, some other exposure, and where does it go, right? So if we're going to land in a disinflation scenario or a stagflation scenario, in a stagflationary scenario, what's the number one best trade? Historical performance year over year, 22.1%. That's massive. That is not a good trade. That is the trade. The trade, right? That's why I was so big on gold, right? And I do firmly believe that we were there. And I think Wednesday we're gonna get the match that lights the fire, or we're gonna kind of stall out. If we stall out, why am I thinking oil? Well, here's the second scenario, right? Oil in the same environment, typically up like commodities. If you go back to the 70s, 80s, oil is like double, quadruple. It's a massive outperformer. And specifically where oil is here, I think that could be a good place for it to bounce. So specifically commodities, and I'm thinking right now just oil, right? That's really where we can. At the same time, if we don't land in this scenario, we do still want to have some equity positions, right? And that's why in this environment, we're seeing a little bit of both, right? We're seeing that FRC halted down. Oh, beautiful. We're seeing a little bit of the equity, high free cash flow, we call flight to quality in equities, outperforming. But at the same time, we're seeing this also gold trade that's like starting to really take flight. So for me, I still want to be in that high free cash flow stuff. I still want to be a little bit of growth. My only real position in the growth sector of that trade is just Google. Still building positions in Pfizer. Happy to, like, haven't really gotten an opportunity to add on any major dip there, but if I don't, I'm still okay right where we are. And again, what I'm looking at now is just going to be really oil services, and that kind of stuff, positioning for this weekend and probably next. My gold positions there, I'm not trimming. Adding here, I think is a little bit more risky. I would wait till after FOMC till we get to see what happens with the actual rate hike. So speaking of the rate hike, here we are this morning. I pulled this from the CBOE Fed Watch tool. This is for this Wednesday's meeting. We are sitting at 475 right now. Currently, the market is pricing in like a 78% probability that there is no hike, right? That we are entering the pause now. And, they might be right. The thing is, I don't know. I don't want to guess this. I think that's a fool's errand. There's a game, like it's just a gambling game, right? But just 2 weeks ago, we were expecting a 50 basis point hike, if you recall, right? So this is how volatile this stuff is. The situation is fluid, to say the very, very least, right? So they're actually pricing in about a 25% probability of a 25 basis point decrease at the same time, which to me is like mind blowing, right? Whether or not it happens, who knows? If they do either one of these scenarios, there's going to be a ton of market digestion. I think really that growth trade gets pulled off the table and starts to stall out, right? If there's no hike, right? If there's no hike, it's like, okay, timeout. Fed's repositioning, right? We need to digest this. If there's no hike in that situation, in my mind, again, gold trade takes off, right? If there's a 25 basis point hike, then I think that growth trade continues on, and we can continue to look for some of those, lower quality things that might be tradable to the downside, and continue to trade some of those higher quality names to the upside in that event. So that's for this Wednesday, right? I took another screenshot of what are we looking at for the end of year CBOE Fed Watch tool. So we're at 475. We were pricing in 50 extra basis points not 2 or 3 weeks ago. Less than a month ago, and here we are at today, right now, currently pricing in about 100 to 125 basis points by the end of the year to decrease. So meaning like cut. This is where I'm like, oh my goodness. You could kind of see this live if you look at the 2-year yield, USO2Y on TradingView. That's the ticker that you want to pull up. I mean, here we are, right? Like, this is a fluid situation. These swings in the bond market are absolutely nuts. If you're trying to decipher what this stuff means, this means that the bond market is saying that there is a recession coming, right? Back to Nick's things, like what are we talking about pulling forward a recession? The bond market saying, hey guys, there's big problems looming. You're probably going to have a recession. At the same time, we have the stock market saying, oh, I think everything's mostly fine, except for these regional banks. So bond markets had a massive reaction. Stock market has had an incredibly muted reaction. The question is now, who's right, who's wrong? Is the bond market overreacting? In that case, then yields can actually probably come back up a little bit. Your bond paper will come back down. So I don't think it's a good place to enter into a bond position right now. If the bond market's right, then guess what happens to equities? Equities need to come down. They've overdone it, right? In that event, gold, oil, commodities, those are going to be your best places. So this is kind of the crux. It's a bit tough, from a macro. This is why it's an investor's nightmare. That's so crazy. But in the interim, it's like a lot of trading opportunities. So we will get to those just a second. I'm going to hit this earnings preview really quick. Yeah, TLC, I know you love it, right? I'm going to hit this earnings preview really quick. So we only have one more Dow 30 component to go. That's Nike this week. And really, if I look at the calendar, that's pretty much it. I think we have like one more week of something where we could fill up some of this calendar, and then it's like crickets for 2 weeks. And then we hit banks again. So about a month from now, bank earnings will start coming up. In the meantime, I think we had PDD Pinduoduo report. It looks like, I believe I saw them earlier. They were doing pretty well. A couple of the Chinese names coming out. Really nothing except for Nike. Got Chewy. Yeah, I'm not General Mills. It's a staples. There's a difference between consumer staples and consumer discretionary, by the way. This is staples. I think that's fine. Discretionary, not so much. Yeah, I think that's it, right? So moving into the week, again, just to recap, right? We started today. We really have nothing. Tomorrow, we have nothing. Fireworks hit Wednesday, right? FOMC rate decision. We're going to be live on Twitter Spaces. Make sure you're following at Paper Gains Inc. On Twitter, Instagram, wherever. We'll actually be there with the crew for the morning, and then there's going to be a couple FOMC spaces live during the actual event. Again, and Thursday, Friday, just digestion days. Really a nothing burger in terms of economic news, except for Wednesday. Wednesday, fireworks all day, right? So that said, let's kick it off into some of these charts, and I'll try to be quick because I know we've gone about half an hour, halfway through so far. So SPY for the week, right? I usually look at all of my major indices up top, right? This is the main stuff here, main view. right? And then I have my four kind of like barometer readings. Right now, I have the 2-year rate, I have the Dixie here, 2-year yields, right? Gold futures, and of course, oil futures, CL for crude. This is the one I'm watching right now. That said, I think that it's very safe to say, well, where's my average weeks? Shoot. I think it's very safe to say that we are in a holding pattern until Wednesday for most of the broader indexes. So kind of try and keep that really on your expectation, like keep your expectations low, fairly muted until then. So I'm not really chomping at the bit to trade a whole lot of anything, right? This range from 393 down to 380, I'm going to call it 385. This is a very, very tight trading range. I honestly think that we stay in here until Wednesday, at which point, if we do break higher, then we have this upper end. I'm going to call this a fair value gap to hit all the way up to like, call it 397 on SPY. Actually, this might have filled. Let's see. Got a 200-day at 393. Yeah, for the most part, this is going to be a tough one. I feel very, very range bound at the moment. Point of control for this 1, 2, 3, 4, 5, 6, 7-day consolidation right at 390. So I do expect SPY to kind of bounce around this. On that, they're going to be couple point day trades that you can bounce off. We'll have to go through those in the servers themselves. Meet with your server owners, things like that. The biggest levels, I'll tell you. So March NFP we got right here. So March 10th, that's when we got our NFP number for the month, right? The high of that candle, right? Mark this on your notes, 393.82. That was the high of the month for the NFP candle, right? The low on the NFP candle is sitting at 384.32. So until we get, let's say, 2 days, close above or below either of these levels, I have no direction on SPY. That's the thing, right? We can see that same kind of dynamic play out on the Qs. Here's the Qs, right? March NFP high, candle, 295, call it 295. The low candle, 287.50. If it was trading below 287.50, I would say, okay, definitively lower. What did we get? We got 1 2-day close above 295, right? And what happened? Boom, we kick off to the upside. Unfortunately, we landed right on February's NFP high candle. So this is the next thing that we have to deal with. 2 days above this, probably if we hold through Wednesday on the Qs above 300, I think we could possibly see. I don't want to say anything. We could possibly see us continue up to the upside. Not a ton of upside on that one in my mind, but for now we have this kind of chop zone that we're looking at. I'm just going to go really quick on SPY. Actually, I'm going to do SPX. SPX on the downside. Here's my level. So this right here, this floor, call it 3,900. If we can hold 3,900 on SPY through Wednesday, I think that's actually pretty constructive. I'm going to go back to this SPY chart because I know I have this on the cleaner view. So I'm going to zoom this out just a little bit so you guys see what I'm seeing. I don't need these fair value gap lines anymore. So I have NFP highs and lows, January, February, right? Or January high, January low. This is that candle right here. So January high, NFP, we're testing it right now. We're not above it, right? The low of January's NFP number 379, that was kind of like the low. This is this big old downtrend that we did break above. We tested the top of it and we bounced, technically looking pretty constructive. So this is the question. Are we going to be deflation or stagflation? Is it generally just deflationary environment? If that's the case, then equities, remember, will do pretty good. If not, this just stays and it probably goes sideways. It's not really going to be a big flush, to the super lows necessarily. If we do, we have that 360 level to contend with. If and only if we just completely lose this downtrend line. That's what we don't want to see. All right. So going back to the broader ones, I'm going to skip diamonds right now. Well, actually, Max wanted to look at diamonds. I think diamonds are going to be, this is industrials. Again, this is a challenged situation, right? We're smack dab inside of weekly range. I'm just going to take this. This is that NFP candle, right? Until we're above 324 or below 318, 2-day close, we're going to be challenged inside this range. And that's exactly what we've seen, especially with that 200-day looming right ahead, right over. If we do break out intraday and get some of these, high wicks, look at 328 to the upside for your kind of real targets. On the other side of the equation, we have the one that's just doing absolutely crap compared to the rest, and that is IWM. We went over why IWM. God, is that a wick? Is that a real wick? I don't know. And this thing is just putting in nothing but lower highs and lower lows. Why? Again, regional banks, small, mid cap, high burn rate companies, highly leveraged companies. This is where you don't want to be right now. So we are dealing with this 170 support right here. And this is kind of where, again, NFP high low. Here's this NFP low. We have got, today's going to be the second actual close below. So this was the 15th. We did get a close below, kind of bounced right off that 70. Today, if we close below that 174 level, this does not look good for IWM. That said, there is a little bit of support. I mean, a decent amount of support. 1, 2, 3, 4, 5. 5 times it's tested this lower support level. Here's the thing with support. The more times it gets tested, the weaker it actually gets. So normally I'd say, okay, well, this is, at this point with this type of momentum and this type of macro environment, this one could really break. It's been tested too many times. Shouldn't see this many tests. This does not look good at all for IWM. So this that if you're in any type of mid cap, ETF, things like that, I'd be very, very cautious here. That said, if we do break, look, this is pretty ugly, man. To the downside, we're in 160s immediately. We get a little fair like 155. It would not, your next level support isn't until like 145. Oh, it sucked, but that's what it looks like right now. Sorry. And that would take like a week to play out though. So Dixie, on the other hand, dollars coming down, man. Dollars coming down. That's all I can tell you. Lower high. This is just, we're continuing to the downside. Again, very dependent on what happens on Wednesday. So I'm going to hold off on taking a real read on the dollar until we get till next week. And we get to that. Same thing with rates. In terms of gold, here we are, right? Huge level that we broke through this morning in the pre-market. Massive level. I mean, it doesn't get any more massive than that, right? Well, it does actually. So it gets more massive over here. But right here, we even broke this guy. Get out of here with that. And this prior high, this is where everyone was kind of looking to short. So again, first breakout. I wanted to see this hold. I think it could pull back a little bit. 1950 on gold futures is a level I definitely want to see it hold. If we get that, I mean, this is pretty good. You pull this chart out to the weekly, monthly, whatever. This is epically bullish, right? So a little cup and handle inside a decades long cup and handle, inverse, whatever pattern you want to draw, you're seeing it, right? So of all the bullish patterns that are potentially play out, it's all of the above, including a little bear or bull flag right here, right now. So it looks great. I'm just saying, if we get a rate hike, dollar's going to bounce, gold's going to struggle for just a little bit. I don't necessarily see that happening. I don't know, right? I can't guess. On the other side, here's why I'm looking at crude, right? We know that the government is refilling the strategic reserves under $70 a barrel, right? Here we are, 65, give or take, massive supply from this technical perspective. And again, we know this is where the government is refilling them. We have a clean range, by the way. So we also know that the government is selling barrels from was selling oil at about $80 a barrel too. So we knew that was actually going to be good resistance from an overhead perspective. And we know the same way that we're actually right into supply at this point, right? So again, this is going to be somewhat headline driven, but from a technical perspective, very, very, very well supported at these levels right here. Maybe it flushes down just a little bit. There's a little bit more downside that could happen. But again, if I get that opportunity, I'm definitely going to be looking at putting on some trades for USO. Cool. I think we're good for now. I'm just going to do a quick subsector check for everybody. If you guys have any tickers that you want to look at, throw them out right now. We'll catch them at the end. Again, what are we talking about? Discretionary, going to be weak, right? Technology, huge week last week. I think this can kind of take a breather. I don't know if it's going to fall off a Chris Sands of the Moon. Yeah, I don't know if it's going to fall off a cliff here or not. Materials, hello. All of a sudden, we're seeing some life. This thing was dead for a while, right? 5-day trend. Materials were down, right? Industrials were down. Where are we at? Industrials up. Healthcare, decent, right? Healthcare has been stable, not blowing the socks off anything yet, but has been stable, right? Energy, oil, energy. I think, where could you look for some bounces? Very, very well supported levels in oil and energy right here, right? Staples, I think, again, flat, down 2% compared to some pretty bloody weeks, 1.1%, 1.5%. Yeah. So energy got beat up completely. Financials, yes, they got beat up, but I think you stay away from that right now. In the servers, I will talk about one company I do have my eye on in the financial sector, and unfortunately, it's not to the upside. But yeah, I think that's where we are. Do we want to see anything else? Yeah, sure. Chris says Santa the Moon. So I do have a position in SAND. That is a small cap gold miner. And a couple of guys were talking about GDXJ. So GDXJ today, we'll take a look. GDXJ, if you don't know, is the small cap miners. I think GDX, big cap miners, they made the move, right? They made a big move. So can they breathe a little bit? Sure. Can they also rally? Yes. But who hasn't really made the move? Those smaller cap ones. These guys actually, they did make a pretty good move, but ton of room to run. Some specific ones, SAND, Sandstorm Gold. This is the typical go-to for me. Daily perspective, boom. Oh, did I get my sell order? I got a little order resting to sell up here. I'll probably take a small position down just to be safe, especially in front of Wednesday's FOMC meeting. But again, very well supported, a big high beta name, so has a ton of potential, like to make some massive moves. Just if you're in this kind of thing, just keep a really good, really close eye on it. What was the other one that we had? It was a small cap miners. One of the guys, let's see, who was it? It was AGI. AGI was one I hadn't heard of, and that one came up just recently as a potential good small cap miner play. Looking at the weekly chart, it's got a little bit of supply here, but this is a lot better in terms of like overall chart than Sand is. This looks like it could be trying to prepare for some kind of sustained move, actually. So nice little pullback here. Want to see this guy hold 11. You do have a fair value gap to fill. So between 11 and 10.75, maybe look for some entries here. I'm just going to throw a alert on this guy for me because it was pretty interesting, at least from a chart perspective. Cool. Motion wants to check PG. So Procter Gamble, that's going to land in your staples section. Not discretionary. It's going to land in staples, right? So this is like toothpaste, right? And cleaning goods, actually decent. So this is a reversal, man, to the upside. Pretty clean reversal. 2-day close over the 200-day moving average. Here we go. Clean up, gap and go today. Upside targets. This is my last trade on this guy. We are here. Upside targets are actually up to 49 and change, just to this fair value gap level and this prior supply. All right. So 200-day moving averages, yeah, they can be a little tricky. Can it pull back a little bit back down to that 143? If it does bounce around 143, that's a go, right? That's a good entry as long as it continues to hold that 143 level, 143.37. Sorry for all these lines and stuff on my chart, but here's essentially the deal, right? You have this prior consolidation here. This is from the December. This is basically almost a month of consolidation. Not unheard of to have that kind of consolidation. That if I extend this over, this is going to be your supply, overhead supply. Anybody that's long here, still caught in it, we'll be looking to somewhat exit, right? So that's why this right here, that's the top of this trade, 149. Until then, if it breaks through, it will likely shoot through this, especially if nobody's really selling. And then you have the next level up to 159 on Proctor, right? For now, this is a very, very bullish chart, believe it or not. So low, higher low here from a very long-term period perspective, above the 200-day moving average, big fat cup and handle. So I like this to the long side. Cool. All right, guys. That's it for me for today. I appreciate you guys showing up. Remember, like the channel or subscribe to the channel. Turn your notifications on. We do this every Monday, and we will see you on the next one. Adios.